I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Lobo Tiggre from the IndependentSpeculator.com. He's speaking to us from Puerto Rico. Welcome back to the show, Lobo.
Happy to be back, Jim.
Without getting too heavy in the tariff wars, which everybody's talking about, can you talk about perhaps specific areas it might impact and how it might hurt or help investors?
I think this is a really interesting topic, Jim. The trade war and the potential impact on the global economy is obviously very significant and potentially bearish, or if not all by itself bearish, it is a bearish factor to the degree that higher costs of doing business globally have a dampening impact on the global economy, then that's a bearish factor. Or does that mean the global economy is necessarily going to go down in flames? I don't know. I'm certainly not making that claim now. I guess nobody really can say yet. We need to see how bad things get, and we need to see whether this brinksmanship actually results in improved trade. I mean, if Trump gets what he wants and there's actually a liberalization of trade as a result, an equalization of the rules and a more level playing field, at least from his perspective, we might see some improvement in the global economy going forward. We don't know what the outcome is going to be, though. We just know that right now, agreements have been torn up, ways of doing business have been shaken up, and markets are concerned, and rightly so. And so it is not unreasonable for industrial commodities in general and for industrial minerals and base metals in particular to face some pressure in that kind of environment. That's a sensible response. So I have to say it is kind of premature. I mean, yes, there's been a first round of tariffs, and yes, there are second rounds threatened. But for the prices to move in advance of the actual harm to occur to the global economy is premature. Now, of course, nobody wants to be the one left holding the bag, so I can understand this happening. Again, I'm not saying it's not ununderstandable. I'm saying that it's premature, perhaps even quite overdone. We don't know how this is all going to play out. And we do know that the trade war or conflict or tension or whatever you want to call it is only one factor. There are other factors moving the global scenario. And one is that, for incredible as it may seem, after all that was done after 2008, is that it does seem that some kind of real recovery is happening. Whether it should have or whether it's been falsely stimulated or whatever, those are philosophical arguments we can get into. But more people are working, more people are visibly getting back into things. And so I can't sit here as a free marketeer and say, no, the economy is all terrible and this is all imaginary. I agree with John Williams from Shadow Stack that things are not as good as they look, but I can't deny that things are getting better. And that's a countervailing factor. That's a bullish factor countervailing the bearish factor from the trade issues. And there's also just the fact that the population of the world continues growing, that people need these minerals and materials to have the quality of life that they're striving for. And China and India continue growing. They continue to want a higher quality of life, and that's going to take huge amounts of these minerals, regardless of what happens with the trade war. So, even if we get a full-blown trade war and things get much more expensive in terms of international commerce, it's not going to be the end of commodities. It's not going to be the end of resource demand, exploration, production, and profit. So first and foremost, that would be my message, is to bear in mind that this whole trade war thing, whether you're for it or against it or whatever your view is, acknowledge the fact that it is shaking things up. But don't panic. It's not the end of the world. Does that make sense?
Well, I mean, we see record high employment in the U.S., nearly record high employment in Canada. Why would you want to mess around with that, experimenting with tariffs?
I understand. The other answer would be, well, now that we have these record high employments, now is the time to shake things up. If the economy was really precarious or looking really precarious and about to fall apart, that would be a terrible time to do this. But if you believe that it's strong enough, it's robust enough to handle a little shock or a few higher tariffs, then that might be an argument for doing this. Personally, I don't agree with that. Donald Trump does not call me up and ask me for my opinion, so I'm not going to sit here and get upset about it. I'm just observing that it's happening, and these are the consequences. And for particularly our resource investors out there that are listening to us, I think the so what, though, isn't just, okay, don't panic. I mean, I'm trying to be positive here, but not just to be Pollyanna optimistic. The importance of the don't panic is that then you can see the lower prices as a buying opportunity. So what I was saying earlier about the global population continuing to grow and the need for these materials, it's not going to go away. It's not like suddenly the world can wake up someday and not need copper anymore. Certainly not in our lifetimes. So low prices in advance of known increased demand and needs is an opportunity. The timing of that, well, that's another question. But I would go one step further, though, and not just say that for commodities in general, for industrial minerals in general, low prices are an opportunity. I do believe that. But I would say that the new energy paradigm is driving the need for very specific commodities, and that is happening regardless. We've talked about this before, Jim, in terms of a better mousetrap can do well even in an economic downturn. I would say it can do well even in a trade war. These new products that have the batteries and the solar technology that go into this whole paradigm that we're seeing the world shift into in an accelerating pace, it requires, it's not optional, it requires certain minerals. And some of those are abundant and some of them are not. There is and will be profit to be made for the people who can get on board and buy while prices are down, because that supply crunch is coming and that need is baked in the cake. And I think the profits for the people who act now while others are fearful. I mean, even Warren Buffett says, the time to be greedy is when others are fearful. We have a fearful summer here. For the courageous among us, I think it's going to be the foundation of a very profitable future.
What kind of areas do you think people should be looking at?
Well, I've given a broad brushstroke there of some of the areas. The specific minerals, my favorites are cobalt, even though it has come under pressure lately. We see structural supply deficits very much baked in the cake there. So I like cobalt a lot. I like copper a lot. Some people don't think of copper as an energy mineral, even though it's been used for conducting electricity for a long time. They see it as, Dr. Copper is a broad industrial mineral. That's true. And if the global economy cools off, then some aspects of copper demand will cool off. There's no doubt. But the fundamentals for the metal are very good. The overall supply and demand picture is one that I'm projecting shortfalls in copper supply for years to come down the road. And on top of that, it is an energy mineral. It is used in far greater quantities in the electric cars than it is in the conventional cars. And never mind the electric buses or semis and airplanes and all this other stuff coming down the pike. So I'm extremely bullish on copper. I like cobalt, as I said. And the other one in there that I really like a lot is nickel. Nickel actually had a pretty good year until recently. It was doing better than most of these, and it's come under pressure like everything else lately. I definitely see that as an opportunity. Good nickel projects are hard to find. The market is dominated by projects in high-risk areas, and Norilsk is one of the big players there in Russia. Russia's subject to sanctions. Nickel is something that could, given the right geopolitical shifts, suddenly shift very higher. And even if that doesn't happen, we're projecting, again, significant structural supply constraints in the nickel market, which is very bullish. Now, I'm not promising any of your listeners out there, Jim, that if they buy stocks that are related to any of these three metals today, that those stocks will take off tomorrow. I want to be clear on that. all I'm saying is that lower prices are an opportunity, and these three in particular, I see very much as Rick Rule would say, when, not if question.
We'll have more with Lobo Tiggre right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Lobo Tiggre. With tariffs, is there an understanding that it's not the country you're putting the tariffs on that's paying the price, it's your own citizens to buy its goods? If you go into a Walmart, for example, you'll find that most of the stuff in Walmart is from China. What are they going to do for their supplies and try to keep the prices down for their consumers?
Well, there you go, Jim. You're getting political on me there. I'm not going to answer that, not because I don't have an opinion, but because it's not directly relevant to my areas of investment. We've talked about the ways to play the minerals and relevant there. That's a very good question, and I think you should ask the White House. But on the other hand, I will throw in, try to balance it a little bit. Trump does have a point with a lot of the stuff he brings up. China doesn't play fair, and people put up with it a long time. So, is what he's doing the right thing to do? I don't know. But there is a reason for him to be doing it. And I don't know how it's all going to play out. I do know that the world needs the minerals that we've talked about, and that the trends are very strong for them, regardless of the answer to that particular question.
What about the energy market right now? We haven't heard of any oil boycotts or tariffs and so on, except the U.S. has asked its allies not to buy Iranian oil. And I've wondered out loud, if you put tariffs on all your allies, will they help you support your Iranian oil ban?
What's the incentive to play nice with the bully? I don't know. That's another excellent question. But it's interesting that you mentioned this, because we've talked about oil in the past. And oil was heading up. It went over $70, $72. It had up to $74. And a lot of people were saying, it's on its way to 80 and 90 maybe by the end of the year. OPEC is tightening up, and yay, oil. But we talked about this before, and we pointed out that the relative scarcity of oil, or the drying up of the surplus, it's not really scarcity, the drying up of the surplus, the glut in the oil market, was simply a basis of decisions that producers made, particularly Saudi Arabia and Russia. Those decisions are easily reversed. So there was no real structural supply issue there. It was a decision on the part of some market players to help drive prices up. And they succeeded. And now they're opening up the spigots again. And you have Trump asking the producers to produce more, that it's gone up too much. And you have Libya coming back on the market. That's a proximal cost to the current drop back under $70. So I'll toot my horn a little bit here, Jim, and remind your listeners that we talked about this, and we said this could happen, that the rally in oil prices might not be sustained because it was a decision, not a structural issue in the market. And so I'm very cautious about conventional energy going forward. I'm not saying there isn't money to be made there. I'm saying those are dangerous, choppy waters. And right now, I'm much more comfortable buying the new energy minerals that we talked about while prices are down. And of course, if people want to know specifically which companies I like, then they can subscribe at independentspeculator.com, and they can read, where I am putting my own money in these spaces. But anybody can see the writing on the wall there. You can do this at home, and I encourage everybody to do, the best due diligence they can. But of course, invite them to come check out what I'm doing.
Well, oil prices were down in the 30s. People weren't investing any money in oil exploration or developing even discovered oil plots, could that lead in the not too far future to a shortage of oil?
No. I think that could eventually, but no. One, low prices are the cure for low prices. And two, we also know that there are a lot of wells that were drilled and not put into production. You've got a drill contract, you've already paid your driller, or you've committed and, contractually to pay the driller to drill off a certain number of holes, prices go down, you're contractually bound to continue drilling. So, I don't have the latest weekly stats, but this is something that is reported regularly, and you can check out the stats. There's a large inventory of drilled but capped wells that are not in production. So, no, it would be very easy, and that's just in the U.S., never mind around the world. It'd be very easy to bring new supply back online. And another thing is that oil's not like a mine. You put a big mine on care and maintenance, and unless it's an extremely high, almost production level of care and maintenance, the mine will degrade. And if it's a wet mine, it can flood. It can be very difficult and time consuming to go back into production on a mine that you pull the plug on. Whereas an oil field, if you turn off the spigot on a valve, you can open it up again much more easily.
We'll have more with Lobo Tiggre right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Lobo Tiggre. Lobo, zinc, not a sexy metal at all, but is that something that people should be looking at, considering that the three largest mines that produce zinc either have closed down or are in the process of closing?
That's another question I'm glad you asked, Jim. Zinc, of all the main industrial metals that you can look at the charts easily online, anywhere you go and look at these prices, zinc has retreated more than any of the others. It's the one that's off the most. And so the contrarian in me wants to say, yes, this is maybe not sexy as you say, but it's an essential industrial mineral. It's off, more than all the others, so this is a buying opportunity. But remember the context. Zinc had a fantastic 2016 and didn't correct anywhere near as much as the other metals did that year. And it was at, record highs, multi-year highs for quite a time until recent months. So, yes, it's off more than most, but it also rose more than most before. So in that context, zinc is not especially cheap right now. It's still relatively high after the correction, and it is not rare. This is not a rare earth. It's not a precious metal. This is a relatively abundant metal that is often a byproduct of other mines. And some mines have a lot of silver credits there that make the zinc worth mining, whether it's highly profitable or not. So I'm not worried about a zinc shortage. I don't see it as especially cheap right now. And even though there have been some big shutdowns, as you mentioned, there's also been other shutdowns, in particular in China, that are reversible as those Chinese producers comply with the new environmental regulations. Some of that supply will be coming back online. I'm not necessarily saying that zinc is going all downhill from here. I am saying that I think it got ahead of itself. It rose too far too fast, and the current correction seems healthy to me, and I don't know that that's going to be the first one to rebound.
Lobo, you're going to be at the Sprott Conference in Vancouver over the weekend. What do you expect to see and hear there?
I'm glad you brought that up, too, because I've been sort of incommunicado almost for some years. Under my previous employment, I was not allowed to correspond with or even talk to readers other than from the podium. So I want to encourage any listeners of yours who've been my readers or even friends in the past for whom I disappeared to come down to the show. I can talk to you now. I can shake your hand. I can act like a human being again. Very much, I'll meet with companies as I always do. I'll be grilling executives. And by the way, I'll be doing some of that in public. I'm not sure why they've agreed to this, but a number of company executives have agreed to come down to my booth and discuss their projects with me in public. Usually we have these conversations behind closed doors. So this time I'll be doing it in public. That'll be good. I expect to uncover useful information there for the observers, and I plan to record these and broadcast them on my website afterwards. But to answer your question directly, the thing I gotta say I'm looking forward to the most is actually getting to talk to people again. And I plan to hang out at my booth during the whole show, whether I'm interviewing companies or not. And I want to be there. I want to be able to shake people's hands and talk to them and ask them, what their concerns are, what they'd like to see me cover more, what I can do, and I'm really looking forward to that.
Lobo, thank you so much for chatting with us.
Thank you, Jim. Always a pleasure.
My guest has been Lobo Tiggre from the independent speculator.com. He was speaking to us from Puerto Rico. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for our show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.